Well, good news as we head into the month of April. Fuel prices are expected to fall between 2 and 9%, with LPG expected to see the biggest decline. That's according to the Institute for Energy Security. It is attributing this to the fall in prices of crude oil on the global market generally, and also on the city stability. Nana Mwesi VII is Executive Director of the Institute for Energy Security. He has been speaking to Joy Business.
Fuel consumers must expect another round of fuel price drops in the coming days. The imminent price drops is a reflection of happenings on the world fuel market over the past 2 weeks, which shows declines in prices of gasoline, gas oil, liquefied petroleum gas, and some other finished products. Over the period under assessment, the Ghana cedi also posted some stability against the dollar, another positive indication for motorists. So, on account of declines in world fuel prices over the last 14 days, and to some extent the cedi stability against the greenback, Ghanaians can expect some relief from the high fuel prices recorded in the past 6 months. Households that rely on LPG will be the most beneficiaries, as the commodity may post a hefty drop in price in the coming days.
Well, meantime, the Bank of Ghana has reduced significantly the amount of dollars it advances to Bulk Oil Distributors to finance fuel imports for the second quarter of this year. What is influencing this decision by the central bank, and should we be worried? Here's more in this report.
New data from the Bank of Ghana shows that for the second quarter of this year, the central bank is advancing $120 million to the bulk oil distributors. This is to help them with the required dollars to finance the importation of finished petroleum products. The data showed that this actually represents about $230 million reduction from what is sold from the distributors from April to June last year. According to the Bank of Ghana, the move can be linked to the benefits of the Gold for Oil program, which has reduced drastically the amount of dollars that these bulk distributors will need to finance fuel import. Officials of the bank have told Joy Business that it is one of these reasons that has helped to improve its international reserves despite the current challenges facing the economy. This has gone a long way to help in stabilizing the Ghana cedi. The country's dollar reserves ending February this year stood at almost $6 billion, representing 2.8 months of import cover.
All right, energy strategist Dr. Isi Suleimanu joins us to discuss the latest developments with regards to fuel. Let's start with our first story, which has to do with fuel prices expected to go down between 2 and 9% from April. Are you anticipating that as well?
Thank you very much, Darrell, and good afternoon to you and your cherished viewers in Ghana and across the globe. Yeah, sure. It's a certainty that that is likely, or most likely, is going to happen. Because if you look at the parameters that go into the fuel price build-up and the factors that could potentially keep fuel prices up and down, you can clearly see that this time around, quite a number of the factors are working to the favor of low pump prices, or to the favor of the consumer. And what are they? Of course, we've seen relatively stable cedi. Of course, though we would have wished that it should have been appreciating some time. I mean, looking at what we were told with respect to this gold to oil, albeit it is still okay, it is stable. And so with the stable cedi, and then the most driver in this case, I think, is the international dynamics. These commodity prices have dropped. In fact, a week ago, we had a collapse, a phenomenal collapse of the market, where crude oil and some of the related petroleum products, especially gasoline, dropped significantly. So if those drops were to hold and we enter into the next window, I believe we will have much more drop at the pumps. Yeah. So yes, dynamics are working to the favor of both the international dynamics and the stability of the cedi. These two main factors, I think, will contribute to the lower prices at the pump coming the next window.
Well, meantime, we're hearing that the central bank has reduced significantly the amount of dollars is advancing to bulk oil distributors to support the import of fuel. What do you make of this news? What are the implications?
Yeah, so the implication there is one of a mixed bag, depending on how they balance it. The problem is gold for oil, we are told, is not able to satisfy 100%. And so they have to make concerted effort to make sure that whatever the shortfalls are, the remaining BDCs are able to get the required capital, the required dollars at competitive rates, to be able to import the product to cover the deficit. So the challenge I see here is the rate differentials, the differences in rate. What rate are we using for gold for oil? Those who buy gold for oil, what rate are we using for them? And also, what rate are we using for, those guys who will come up to get the auction to import this finished product? If we have differentials in this rate, then definitely we're going to have, a distortion in the pricing. But if we are sure that we play our cards well, that we know with great certainty that whatever the gold for oil cannot cover, we should be able to advance the required, capital. The required hard currency, in this case, the greenback, the dollar, to be able to, make up for the deficit. So yes, if the government can balance that differentials, which I think is going to be tricky, and they need to trade cautiously. They need to trade with caution. If they can balance that, why not? I think we'll have a positive. But if they cannot, then it will likely bring some market distortions in terms of the pricing.
Okay, over the past 2 weeks, we've seen the price of crude oil hover around $70 or a little above that a barrel. And this story we're reading right now to do with Silicon Valley Bank collapse. There's an attribution to the reason why oil prices are going down, saying that the collapse of the bank is the reason why we are seeing oil prices crash, because there's a flight of investors who are now putting their monies in gold. Explain to us what is happening and why that is causing the energy market to suffer.
Yeah, so that's a good one. Gold is a commodity just like crude oil and other petroleum products. And so commodity trading triumph, under the space of, peaceful atmosphere, under the space of, trust and confidence. And now if you look at what happened over the last week, the phenomenal collapse of Silicon Valley Bank, followed by Signature Bank. In fact, two banks collapsed alongside. And there was just a likelihood that there could be trade-offs or there could be spillover into other banks. You've heard of other banks like Credit Suisse and other, and some other banks in the US. They were all meant to go down of a sort. And so if a market is going like that, the trust would dwindle drastically. And investors will always put their money where there is stability. And so what likely happened over the week, over those weeks, there is so much loss of confidence in the investor community with respect to the banking system, and that hasn't returned yet, though it is gradually coming back, but it doesn't return yet. So if that happens, investors will likely shift their investment into a safer haven, or a safe haven. In this case, gold has always been one of the commodities that hasn't experienced any volatility that much with respect to volatility in other commodities like crude oil. Yes, so if you notice, as petroleum products and crude oil prices were dropping drastically, gold was appreciating, telling you that this commodity, they are shifting the capital from where we have this anarchy or pandemonium or disturbance, where capital doesn't like, or where investment will not like it, and then they are shifting it back to a much more stable environment, in this case, which is gold. And historically, gold hasn't experienced volatility. If you check, gold has been a stable commodity, and so it is almost likely that investment, if the confidence within the banking sector hasn't returned, then we'll likely see more investment going to the gold sector or other metal sector much more. And that's actually how come the gold appreciated. It appreciated to about 1,900. $1,000 ounces, $1,000 per ounce, and that's significant. And there's a chance that it could go to 2,000 if the banking sector still persists. But the good thing is that I think the confidence is returning back because of drastic interventions that have been put in place to regain that confidence. Of course, we had a lot of learnings from 2008, financial meltdown, and so most of the learnings are put here, where quickly central banks decide. They are beginning to pump so much money, so much liquidity into the struggling banks, and I think it's beginning to yield results. Because as we speak now, crude oil prices have started appreciating. In fact, we are in the upper 70s, and there's a potential that it could go back to the 80s once the confidence within the financial sector, gain momentum.
And so, what does this mean for Ghana's Gold for Oil program? A positive or a negative?
Yeah, so it's two ways. It could be positive and it could be negative. The positive connotation I'll start with is just that, assuming gold prices appreciate, and then we have the gold and we are going to take petroleum products. And bear in mind, gold prices are appreciating, petroleum products also, going down. So it means that with the same amount of gold that we have, we can get more petroleum products. That's simply what it means. And then also meaning that, our consumption hasn't gone up. We still have 350,000 that we consume per metric tons per month. So what it tells us that if you have a drastic appreciation of gold prices, then we could get more petroleum product with the same quantity of gold that we have. But the downside of it is the fact that, in commodity trade, especially butter trading, if the two commodities move along the same direction, let's say decrease along the same route or increase along the same dynamic, it is very easier to draw the correlation. But in this case, one is dropping and one is increasing. The players have to be strategic to take advantage. And in this case, I think we should have been piling up gold reserve at this moment in time. But I think with gold for oil policy, we're going to deplete our reserves. No two ways about that. And so I thought probably we should have been piling our reserves. So the downside that I see is that whilst the commodity gold has always been, the safe haven and gaining momentum, instead of us to store the gold, we are rather using it to exchange for petroleum product, which is a short-term intervention, I think. So that is the downside of it that I can say. But of course, the positive side is there, and this is also the negative side. Yeah.
All right, Dr. Isi Sulemana, thanks as always for your insights into energy matters. Appreciate your time with us. You're watching The Marketplace now.